In today's video, I want to go through the most basic fundamentals of having a conversation with a prospect who wants to get qualified for a commercial loan. I know a lot of you guys have asked me, Zevi, how do you begin that conversation? What do you ask them? And if you don't know who I am, by the way, my name is Zevi Shafran. I'm the owner of a company called Loanbroke, and we're both a residential wholesale and commercial lending shop in Los Angeles. I'm also the creator of the Part-Time Commercial Lender Academy. And it's an easy to follow roadmap that would guide you as an originator through the commercial lending process. And if you want to check it out, it's available for you via link in the description of this video. All right, so with that, let's dive in and get started. Where do we actually begin with a borrower who stands in front of us and has questions about whether they qualify or not for a commercial transaction? And what I want to do is start off the top. And number one is always going to be discovery, okay? And what do I mean by discovery? You're going to have to ask a bunch of questions as to why they are trying to either purchase this property, whether it's an owner property or an investment property, what their game plan is, how much of a down payment they're trying to put. If you're watching this and you happen to be a residential loan officer who's trying to up your game by offering the skill set of originating commercial loans, then you already know in the back of your mind that when somebody asks you about any type of a lending transaction, you're going to ultimately want to know how much of a down payment is this person trying to put down? Where are they trying to buy? Why are they trying to buy? Now, in this particular case, what you're going to find is that a lot of the transactions are going to be owner-user transaction. Yes. And the reason I say that is because what I found out is that in the space of being a commercial mortgage broker, a lot of the transactions that when you're dealing with businesses, mom and pop, they have locations in place, and either they're renting and they just don't want to renew, they want to own something because they build up a certain amount of down payment, right? So in essence, if their business is currently cash flowing, meaning that they're making money, and how would we know that? We're going to get into that in a moment. Then the biggest question is going to be, how much of a down payment are they willing to put down towards the new acquisition of, let's just say, their new location for their business? And the reason I'm saying that a lot of the deals are going to fall under the owner-user is because those are the most lucrative deals. Investment properties are great, but typically, unless there's already a relationship in place, a lot of lenders, they're not very excited about investment properties unless you're talking about a multifamily building, like an apartment building, that cash flows. And we can talk about that a little bit later. I just find that 90% of the deals are going to be owner-user deals, and these are the type of deals that banks love the most. You are the intermediary. You are the link between the borrower and the bank. And for that, you're going to be paid your 1 or 2% commission. Now, depending on how large this purchase is, that's where it makes perfect sense to go after the commercial business, simply because, unlike residential, these deals are significantly larger. And everyone needs a tour guide when they're unfamiliar with the landscape. In this case, happens to be lending. So we start with discovery. We really want to know how much of a down payment do you have saved. And the reason is because in conventional lending arena, typically, down payment is going to vary anywhere between 25 to 35% down for conventional business, and typically anywhere between 10 to 15% down for SBA. Now, this is going to be our bread and butter, and this is why I'm focusing on this. Once we have a little bit more of a discovery as to why you're doing this, when you need to do this, how much are you currently paying, as opposed to if I did in fact get a deal going for you, and let's just say, I'm just going to erase this for a moment. Let's say that this transaction was for an owner user who needed to buy a location for $1 million, okay? And you'll see where I'm going with this in a minute. And let's say that they were able to put down 30%. So we know that they're going to have a proposed loan amount of $700,000. When you factor in the principal, the interest, the property taxes, and the insurance for this new location, assuming a $700,000 mortgage, these type of loans are amortized over 25 years. What I would do is I would compare that, right? So we call that PITI, principal, interest, taxes, and insurance. I would compare that payment to the payment that they have now. Simply because I want to know if I'm somewhat in line with what this person currently has, or are we going significantly higher? Which leads us into the next stage of the conversation, which is basically going to be the doc collection. All right? So number 2 is going to be doc or documents, right? Documents collection. And so reason being, remember we spoke about sizing up that payment of that new proposed mortgage, and you might be thinking, how do I know the interest rate? Wherever baseline interest rates are, as an example, right now we're in March 2025, and the baseline interest rate is, let's just say, 7%. You could use that over a 25-year amortization, and then you basically have a general idea of what the payment is going to be once you add in property taxes and insurance, and you can compare it to what they're paying now. How do you know what they're paying now? Because once you collect their documents, most people, and when by the way, when we say document collection, the income docs are the most important. And the reason being is that every single business, typically, if you're running a corporation, most corporations run as an 1120S. That is the most common. And the first page of the tax return is actually a profit and loss. And what do I mean by a profit and loss, and why is that important? It's important because the top line of the, we're going to call it P&L, profit and loss, which is really going to be the first page of the return of the 1120S. What you're going to see is, you're going to see the top line, and that's going to be the gross income. All right, so that's going to basically show you the amount of money that the business is making. And then right below that, you're going to see a laundry list of the expenses. All right, one of these expenses right here is actually going to be rent. So when you look at the rent and you divide it by 12, you can get a very good idea of what this individual is currently paying. Now, they might say that they pay more or less, but the thing is, typically speaking, you go off what things have been recorded. So even if they pay, example, $2,000, but they recorded $4,000 expenses, and the business is still cash flowing, meaning that there's the gross income, there are all the expenses, and then there is the net income. If there's rent of whatever that rent is, and you can substitute it for the new proposed mortgage payment, and it doesn't change the net income a whole lot, then already psychologically you know that this business is going to be okay, assuming that the credit is good and assuming that they have a sufficient down payment and reserves to be able to put this type of transaction together. You're just trying to get on the right path. You're not an underwriter. You don't have to make a credit decision, which is what I want to talk to you guys about next. But by collecting the income documents, you at least get a picture of what it is that you can expect should you move forward with this transaction. If you see a tax return where there is a lot of gross income, right? There's like whatever, there's like $1 million here of gross income, and then there is expenses of 1 million as well, and then they net nothing. This is a challenging situation, and we got to take a very close look at it. It also doesn't mean that they don't qualify, because remember, a part of those expenses that they wrote off, $1 million to $1 million, but possibly had rent in there, or maybe they currently have a mortgage. And so we have to know what we're substituting for. There's a handful of expenses that are actually credit back to the borrower. And these things get a little bit more complicated, not necessarily something I want to get into in this video, but things like amortization, casualty loss, depreciation, miles, different things like that, they get factored back into the transaction, which means that even when somebody nets zero, they could still have income and then substitute an expense for another expense and then still get the business to qualify, which is where we are going next. Now, you might think to yourself, Zevi, I'm getting the gist of it, but it sounds kind of complicated. Do I actually really need to do all that? And the answer is absolutely not. You don't need to do any of it. As a matter of fact, if you don't want to, you don't even need to look at the tax return. Me personally, I always do. But I want to talk to you about step number 3. Let's talk about step number 3. Step number 3 is, it's called pre-flight. And so pre-flight is basically you having an established relationship with either a commercial LO, loan officer, right? Or a business, it's called the BDO, business development officer, or a relationship manager. Okay, so it's called an RM, relationship manager, business development officer, or a commercial loan officer in the bank. One of these guys right here needs to know how to pre-flight a file. And what does that mean? It means that they need to know how to run the spreads. Running the spreads means you collect the financials and you give it to one of these guys to do. They are the ones who are going to go through the journey of what I just discussed with you on number 2, which was the doc collection and having to review some of the documentation. And that's why I say you have a lot of support in the process. It doesn't all necessarily fall on your shoulders. And so the idea is, can we actually qualify this individual? And if we can in fact qualify this individual, then what could we actually offer them? All right. And so that's a pretty big ticket right here. Now remember something, this doesn't mean that the file even goes into underwriting. I'm not even talking about that, because that would mean that you're officially making a credit decision. You basically just don't want to waste a bunch of your time. There's other things that fall into this category, because when you collect documents, you want to make sure you do it in a certain way that is secure, and then you can share that information, with the lender. You also want to make sure that their information, whichever way they collect it, is encrypted, so your borrower's information stays secure. We went through a discussion with the borrower to collecting their documents, having the documents reviewed, which was the pre-flight. Then the next thing is going to be us putting together some preliminary terms. Now, mind you, these are not the final terms. These are the preliminary terms that you want to go ahead and convey to your borrower. And so once we have the terms, because we know this person is serious about putting a deal together, what I typically do is I share them with the borrower. There is a couple different ways to do that. You could do it in a formal way, which would be a proposal. I typically don't do that. I just put them in an email. If these terms are in line with what the borrower has in mind, then we are getting ready to initiate a transaction here. It's important that you fully understand the terms yourself before you ship them out to the borrower. And this might sound silly to you, but I've actually worked as a production manager, managing teams of commercial loan officers. A lot of times I would ask them the very basic questions of, what are you offering this individual? What type of a loan is this? What are the terms? Like how long is this for? Is there a prepayment penalty? What is a monthly payment? Is there an interest-only component to this? All right, is there a balloon payment? They would have no idea. And so make sure that when you get your terms, you're fully versed, you understand exactly what it is that you're about to pitch to the borrower, and then put it in an email, jump on a call, have this discussion with the borrower, super important, get them engaged. That was our number 4. Now, mind you, all this is preliminary because we're just trying to get the deal off the ground, which leads us to number 5. And number 5 is my favorite. It's drafting the LOI, the letter of intent. Letter of intent, letter of interest. This is where I take the terms that we have discussed via email or on the phone, and I put it in my company letterhead, which is, by the way, available for you as a white label as part of the part-time Commercial Lender Academy, which is available in the description. And what I do is I put all the terms in there, and what I also include, which is also available for you, is an exclusivity agreement that for a certain period of time, you're going to be using my services and nobody else, and you're not going to circumvent me. So I have an opportunity to work with you for typically 60 days to put a deal like this together and then come out the other end and earn a commission. All right, so that's typically how the process is done. Now, one really big thing about drafting your term sheet, even though the deal isn't fully approved just yet, but you lined yourself correctly to get on the path of initiating this correctly, knowing that the borrower has at least gone through the pre-flight stage. So you're not guessing as to, is this going to work? Is this not going to work? There's a very good chance this is going to work. And as a matter of fact, don't run credit either. Let the lender always run the credit. And in addition to it, the one thing that I like the best is the fact that I get to collect upfront a $1,500, sometimes $2,000, depending on the transaction, non-refundable processing fee. And I work together with my processor on this fee. I collect it up front. It's great to do that. I wouldn't recommend you not doing it. And it's only done after the person actually signs their term sheet, their LOI. And the reason being is that, one, you know that they're serious. Two, you bring them a little bit closer to you when they get their checkbook out. And number 3, you're collecting money up front, meaning that even if the deal falls through for any particular reason, and a lot of times doesn't even have to do with the financing, could be with the physical transaction itself, meaning issues with the property, third-party reports, different things like that, you still collected some money to work on this transaction, all right? Hopefully, this was an educational video for you. I know we covered a lot of ground. Trust me, follow these steps. It's what I do on every single transaction, and you'll be well on your way to originate commercial loans. If you want to learn more about it, like I mentioned earlier in the video, I worked a year to put together this program, It's very detailed, and it includes all my proprietary work and forms that you can white label to your company as well. If you've enjoyed my video, please give it a thumbs up so other people like yourself can find it on YouTube, on the internet. And then in general, if you like videos like this, go ahead and subscribe to my channel. I appreciate you guys watching this. Thank you for being here, and I'll catch you again on my next video. Take care.